Well, hello, everyone. The bell has rung, the trading day has ended, and thus has begun our last live webcast of the day. My name is Barbara Armstrong. This is After the Close, which is typically taught by Kevin Horner. Kevin has a well-deserved day off today, and this will be not only the last After the Close webcast of 2025, it will be the last After the Close webcast. So I'm going to officially announce, and I'm sure that Kevin did also, that this class starting next week at this time will still be taught by Kevin Horner, but it is being renamed and repurposed, and it will now be called Building a Stock Portfolio. So we're going to talk a bit about building a stock portfolio, and you can do that during market hours. But if you're like some people where you're working a busy job and the only time you have to look at and make these decisions is after the close, it applies, under both naming conventions and, under both strategies. So that's what we're going to talk about today. We're going to look at two different types of trades. One type of trade that a trader might place with the goal of generating income that they might want to withdraw from the account, or it might be just a way of growing the account. And another one type of trade might be of more of a longer term trend trade. And we're going to look at examples of both. I want to thank those of you who are joining us here in the chat. I've got Brent Moores in the chat with me. He's a friend and a fellow coach. He brings a wealth of experience. We've worked together for the better part of a decade. So if you've got any questions, please don't hesitate to ask. And between Brent and I, we should have answers for you. I want to thank Jay and Ricebird and Becca and Alfie and Will and the rest of the gang for typing in, and helping bring this class to life by being so participatory in the chat. If you aren't following Brent and I already on X, I invite you to do so. His handle, Brent Moore CS, mine, Barb Armstrong CS. We're posting lots of helpful content on a day-to-day basis, and it's a way for us to be able to communicate with you and you with us outside of webcasts like this. So just before we get started, keep in mind that options carry a high level of risk and aren't suitable for all investors. You also have to apply for option trading privileges with Schwab, and not all will necessarily qualify. And while we use technical analysis in this webcast, other approaches, including fundamental analysis, being aware of earnings and what's going on globally in the markets, helps us make a more informed decision. We will use the Paper Money software application on the Thinkorswim desktop platform today and for our examples. And it is a brilliant place to learn if you're new to all of this. Paper Money is where we'll be placing our example trades. There are some nuances and differences. One is that with a short option, and today we're going to do an example where we're selling a covered call. It's called a buy right covered call strategy. A call will never be called out ahead of expiration in Paper Money. That can happen in a live account, and we'll discuss that as we go along. Also, stop loss orders are not a guarantee that we'll get out at the price requested. So let's go out to the platform. Okay, somebody's saying that Santa is lost. I think they're referring to the Hope for Santa rally. And the last couple of days, we've seen a wee bit of a pullback, but we hit a new all-time high in the market intraday high on Friday of last week. So, he may not be like shooting to the stars the way you would like him to be, but he's not doing too badly. So that's where our S&P 500 is. NASDAQ, setting up a bit of a pennant pattern, which it has yet to break out of, but, still, not that far off all-time highs, up 20% year to date. And when we look at our volatility index, we're at the low end of the range. In fact, last week, we pegged a new low on the VIX for the year. So there's a pretty high degree of confidence when we're sitting at 1430. So Santa, he's not doing too badly if we're talking about the Santa Claus rally. Now, the strategy I wanted to start with, and we're going to look at Newmont Mines as an example. And so gold and other precious metals like silver have done very well this year. Newmont is a gold mining stock, and it is up 175% year to date. And so some traders might look at this and say, like, Barb, we've missed the move. And you may be right. Maybe this uptrend is, drawing to a close, but what if it isn't? And what if we looked at Newmont and said, okay, maybe I don't want to put a ring on it and consider this to be a long-term investment, but maybe, I have a portion of my portfolio, and I think that Kevin is likely going to kick it off and add some more structure to this. But let's just say you're deciding that you're going to take over managing your money, or you've inherited some money and you want to invest it. And part of it, you want to generate some income that you want to put aside for the trip of a lifetime to Italy or something like that. And so could we look at Newmont and say, hey, this has been uptrending. We're seeing this series of bull flags. It hit a new high last week. When we look at this, it came up, pulled back for a few days, came up, pulled back. Still a series of higher highs and higher lows. And then today we have this close above the high of the low day, which from a technical perspective could be considered an entry. And so if we look at this and we say, well, if I just want to make some short-term income, could I maybe this recent high just Friday was 106. Could I come out here and sell a covered call at 106? And with the goal ultimately of being called out. And how much might I make if I did that? And so let's go and see. So if we come out to the trade tab, even if we just come out to January, let's make this 10. So this is only 17 days. I mean, this is not a long-term commitment. If we sold the 106, and this is in the after hours, and so these bid-ask spreads are a little wider, it was about 20 cents before the market closed. And so if we put this in and we said, well, we've got 400 contracts here. Newmont traded over 6 million shares today. And in Thinkorswim speak, we call this buying covered stock. If I was to buy this, how much could I make? Well, the most I could make on this would be $6 a share, right? Or $6.05 a share. So if I could make $6 a share on let's call it $100 investment, that sounds like a 6% return if I were called out in 17 days. Now, it might not go up to 106. It might never go up to 106. In fact, it could go down. And if it went down, when would we want to get out? Well, we might say, well, hey, yesterday the low was 97.67. So I'm going to go in and say, well, if it goes 3% below that, not going in the right direction, I want out. So I'm going to multiply that by 0.97. So that would be 94.73. Let me just double check that. 97.67 times 0.97, 94.73. So we're going to put our stop at 94.73. And how much are we risking? Well, if we're paying almost $100, we're risking about $5 a share, right? If we were to be called out. And you might say, well, how can I get out of this and put a stop in because I'm selling this covered call. And if I sell the stock, then I have a naked call. Well, we're going to change our advanced order to first trigger sequence. And then we're going to create an opposite order. And we are going to make this a market order because we don't know exactly what this option will be worth, our covered call. We expect it will be worth less, but we don't know exactly. But we're going to say, hey, if this comes down to 94.73, it's not going in the right direction. And I'd like to exit the position. Now, we have $1 million account here in our paper money account, in our pretend account. And, we have 500,000 sitting in cash. So we might say, hey, I'd be willing to take a position up to 5% of the account value, but I don't want it to be any higher than that. Then we could do 5 contracts, 500 shares. Because 500 shares would be close to $50,000, right? And then to get out, 500 shares. And this, we're going to make a day order. In other words, if this, the market's now closed, it will go live tomorrow. And if it doesn't fill by the end of the day, then it will expire. But are we under 50,000? Yes. And if we're saying, hey, we don't want to risk more than 0.5%, we'd be willing to risk 5,000. How much are we risking? $5 a share, 2,500. Now, if it gapped down, we could get out at a lower price than that, but it's in the ballpark. In fact, it's half what we are allocating for our max risk. And there's a transaction fee for the covered calls, 65 cents a contract. And so we would put this in our buy right covered call section. And we might make a note for ourselves that our goal is to be called out. Now, sometimes, things don't go according to plan. So let's discuss that. Like if we are called out, how much would we make? Well, we could make up to $3,025. Now, what if the stock went up to 110? We'd still be capped at that 3,025. What if tomorrow some kind of news came out and Newmont gapped up, and if it were in a live account, we were called out? Would we be crying in our cups? No, because we're saying, hey, if we can make a 6% return in 17 days, we're happy campers. So if we got called out ahead of time, would we be sad? No, we'd be delighted. Okay, so we've teed that up for tomorrow. Now, what if it goes up and we've got our covered call here at 106 and it expires in January 16th. So this is our buy right. And buy right just means we both bought the stock and we've sold the covered call. And January 16th is our expiration date. So when we go in and look at this, we know what we're aiming for, and we're buying it. We put the order in on this day. Now, what if it goes up through our strike, which is what we're expecting it to do? What if it goes up through our strike and doesn't get called out? And just because it's in a live account doesn't mean that it can't get called out. Like it could be called out, but unless it's pretty close to expiration, it might not be called out at all. And then what if it comes back down and come expiration date, it's sitting at, say, 105. So it's below 106. So it would expire worthless. We'd get to keep that premium that we sold, and we get to keep the stock. And then what could we do? We could sell another covered call, or we could just exit the position. Now, what if it doesn't do that? What if it came up and then that became a new ceiling and came back down, and it's a few days before expiration, but now it's only worth about 20 cents? Or maybe it's worth 30 cents. Well, we've got 90% of our max gain. We might just say, you know what? I'm going to take my risk of being called out off the table. I'm going to buy it back and then wait for it to rally if we're expecting it to rally again. And then I'm going to sell another covered call. So we could kind of do a wash, rinse, repeat. And then we do have a stop on it. And that stop, we put it 94.73. So if it does come down and trigger our stop, then we would buy back the covered call and sell the stock, and we'd be out of the position. And we'd have recognized a loss on that trade, and sometimes that happens. Okay, but the goal obviously is to make money, and you might just want to grow the account. So you may have no need for the income, but you may say, I want to do some short-term, more aggressive growth strategies. And you could do this as a growth strategy. And others might say, I want to generate income to either supplement my current income or supplement my retirement income or whatever that may be. And you're going to set a goal for yourself of how much you might want to make a month or a year or a week, or, you know, it's your goals are up to you. Now, what if you're saying, you know, I'm many years from retirement, I've, you know, got this portfolio and I would just like to invest in something. And as long as it continues, you know, to be strong, I'd like to continue, you know, I'd like to just buy and hold. So if we looked at Google, so if we had bought Google back here, and again, here's another stock up 60% year to date. So, you know, it's been uptrending. This red line is a 30-day moving average. And, you know, it's come and kissed it a few times, but it really hasn't crossed and stayed below the 30-day average much since, well, since it crossed back here in April. It's really been, you know, pretty strongly uptrending. And you know, some would say an object in motion might stay in motion. Now, there's no guarantee of that, of course. But if we came and we looked at this and we said, well, it's come back to this 30-day moving average and it's bounced and continuing to move up, you know, and this is an expensive stock. It's $313 a share. You might want, come earnings time, the ability to be able to buy a protective put, or to sell a covered call and buy a protective put. We call that collaring the position, if you think it's going to continue to go sideways. So if it came up here, like if we entered this today, and then let's say it came up around this 328 level again and started to pull back, could we sell a covered call? Say, oh, well, you know, maybe it's going to consolidate for a bit and it would be nice to just make some money as it goes sideways. Now, whenever you sell a covered call, you know, there is the risk that you could be called out at any time, regardless of how far it is in the money. But if you're saying, you know, as long as this continues to go up, I'd be okay with continuing to own it. And then how do you define no longer going up? So in getting started with technical analysis today, we did an example using another gold mining stock, Anglo Gold. And we kind of went back and said, what if we had bought it here? And we walked through this exercise of updating our stops, which if you're new to buying stocks and holding them and managing a position, you might want to go back and look at that. But the idea with Google, if we had bought this, back, let's say if we had bought it back here, our first stop, and we'll add a position to, our example portfolio. Our first stop might have been around here. And then when it came down and closed below the 30-day moving average, we might have moved the stop up to here in an attempt to try and protect some of the unrealized gains in the account. And then, if it came up and recently hit below the 30-day moving average again, it closed below, we might have moved our stop up again, but we'd still be in the position. And so if we're looking at that, and I do have a position on Google in this example portfolio, and if I show the orders, you can see here's where the original stops either were placed. We haven't managed the routine of adjusting our stop. So if we looked at this and we said, okay, here was our recent low at 296.12, I'm going to move that stop up to 287. So you could just take your stop, and on this, you can just drag it up. We want to make it about 287. So I can come here and it brings up a window. And if I want to make it specifically that 287.23, I can just come in here, and it's very quick and easy to update your stop. And now I can see on the chart that stop is about where it should be. Okay, and then I could do the same with this other position. But if I didn't have a position on Google and wanted to add one, I could come here, calculate when I'd want to get out. And then, how long do I want to stay in Google? Well, as long as it continues to uptrend, or maybe, if this stock paid a dividend, which, if you're wondering if a stock pays a dividend, you can come here and it'll say, okay, the dividend yield is less than 1%. So it's pretty nominal. And there's no saying that it will continue to pay a dividend, first of all, in the future. Secondly, in paper money, dividends don't actually get paid. So that's one of the differences, between paper money and a live account. But, if it goes sideways, then we could, as we discussed, consider at that time selling a covered call. But if it comes up to 328 and keeps on going, we might be glad that we didn't, because we're putting this in a different part of our portfolio where the goal is just to continue to own the position. And sometimes that can serve us well. So here are a bunch of growth stocks, and that do not assume that there's been superb management here. There has not. I don't actively manage, but this Google position is up 60%. And we're up 6% on Apple and 4% on AVGO. We're down a little bit. Well, this AU position we just put in a couple of hours ago. But you can see, the returns. Now, if this were a real account or an account for a class I was teaching day to day, we'd be managing this a little closer. But one of the things you can do is just come in and say, if we looked at Apple, if your routine is to check your stops, you can come in and say, ooh, I'm not sure when I bought this, but it recently came down below. It looks like we have a support level here. So if I said 266.95 times, 266.95 times 0.97, I'm going to move it from where it is around 240 up to 258.90. And what's the reason for that? Well, the goal, so we're pretty close there. 258.90, we're pretty close. So we're going to leave that in our in this spot. but what we're trying to do is protect some of our profit. So here we paid on average $2.56. We're not protecting a whole lot of profit, $2. But we're just trying to manage our risk. And this ended up, it's not showing a little chiclet because I need to move this to our stocks for growth group. And if there is one of these little sell orders missing, it may mean that your stop has expired and you need to add a new one. But if we didn't own a position on Google and we wanted to add that today, we might say, okay, we're going to buy 100 shares of Google. I'm going to be resetting this account at the end of the week. So we'd like to buy 100 shares of Google. And we're going to put a stop in at $258.94. And so how much are we risking? 258. How much are we risking? Well, we're risking the call it 314 minus 258.94. Oops. Hang it. Let's call it 314. I'm rounding minus 259. So we're risking $55 times 100 if we buy 100 shares. So we're risking $5,500. So that's at about the max that we're willing to risk, was around $5,000. And we're at that with this 100 shares. Even though it's not a $50,000 position, it's a $30,000 position. Well, 31,398. So we have two components to position sizing, that we have to keep in mind. Okay. And so we put that in our stocks for growth. And the purpose here is continue to own it. We aren't looking to make, an income that we want to withdraw within a month, or we're willing to be a longer term investor. Now, if you really wanted to be a longer term investor, not weeks to months, but maybe months to year, you might time your entries more based on the 100-day moving average or the 50-day moving average rather than the 30. And, when we look at Google, it crossed the line back here. And, we wouldn't have even had the need to adjust the stop if we were saying, well, we're not going to adjust the stop unless it goes below the 100-day moving average. Or, we're going to continue to use that as our measure. And so if you were to adjust the stop, you wouldn't base it on this recent low. You'd say, well, here's my 100-day moving average at 263. I'm going to put it below there. And why might an investor do that if they want to be a longer term investor? Well, they might choose to do that because they don't want to risk being, whipped in and out. And if we go back to this AU example that I talked about earlier, and I didn't get to discuss this, if we were using the 30-day moving average, we would have got in here. And sorry, this chart is a little busy and I do apologize for that. But let's say we bought in here, we would have ended up stopped out here because it just nicked out. It went 3%. If we had adjusted our exit here, we would have been stopped out, and then we would have been back in again 2 days later. And based on the 30-day moving average, we would have been out here. And then, and then we got back in here and got back in here, and we would have still been in. But if, we would have had a nice profit both times when we exited. But if you look at it and you say, well, if instead of doing that, if I wanted to be a longer term investor, I'm just going to wipe all this out. If I had got in at the same point, which let's just assume for argument's sake, it was back here, you know, or if we go back a little further and say, I'm going to enter when it crosses the 100-day moving average, even if we waited for it to rebound and come back, maybe we got in here. We haven't come back and hit the 100-day moving average yet. So we would have bought in around 29 and we'd still be in today. There would have been no in and out. You know, so there's pros and cons to either one, and there's no absolute right or absolute wrong. It just depends on your time horizon as an investor. And so that's important to keep in mind. And, you know, when the market pulls back, you know, sorry, if I come to a 2-year, well, this has been pretty much uptrending all along. But, you know, a lot of stocks at the beginning of this year had a fairly dramatic pullback. And if they cross that 100-day moving average, you might have given back more of your gain than at the 30. But then you're also avoiding kind of this, the potential of getting, you know, whipped in and out. And what happens with a lot of people is they end up out and then they don't have the discipline or a set of rules where they end up back in again. Does that make sense? So you want to make sure, you know, because I remember when I first started, I had a position and it did really well in this paper money. And when we exited that position, let's say we had 1,000 shares, the next time we position size, we only got in with 600, but we got back in. And somebody said, gee, most people don't do that. It's like, well, then they don't have a plan and they're not following a set of rules. So if you do want to see an example trading plan, if you go and if you haven't subscribed to the Trader Talks channel, you'll want to do that. Trader Talks from Schwab Coaching on YouTube. The button's in the bottom right-hand corner of your screen. And when you first get there, you know, what comes up is what's currently being taught. But if you come to the playlists, I've created some example trading plans. And so if you come down to these mini sessions, I'm doing a very, you know, bite-sized pieces on candlestick patterns, which you're welcome to do some binge watching if you're sick of Netflix. But here's a simple stock investing plan. That's basically as I just described it. And I just did a new one today in the Getting Started with Technical Analysis. If you'd like to go back and watch that, it used an example from today. So that's a resource you can use. Also, you know, things are changing, as I said. So if you come to schwab.com/coaching, and there will be notes down below. If you come to live webcasts, and we've got December up, but I am going to go to January. And it will bring up the last couple of days of December just because the new week starts on Thursday. But you can see that this new class in this same time spot will be called Building a Stock Portfolio and will be led by the fantastic Mr. Kevin Horner starting next week. There's also going to be a new class called Investing in Dividend Stocks that Cameron May is going to teach. And then last but not least, by popular demand, investing in ETFs. It was taught by Connie Hill and Pat Mullally before that, but it is now going to be taught by Rachel Dashel. And it is one of only 2 classes each week that you must attend live. They are not archived. So, and I'd highly recommend both of them, but just one sec. Investing in ETFs is one. and Trader Talks on Fridays with James Boyd and Kevin Horner is dedicated to ETFs. Yeah. And so these two are not archived. And so be there, be square. You'll want to be there live, 4 o'clock Eastern for investing in ETFs on Monday and starting next Monday, the 5th of January. And, you know, this one's been rolling for a while and is a very highly attended live class with James Boyd and Kevin Horner Mondays at the Fridays at the market open. As somebody's asking, you know, what's the deal with it being live only? This is a regulatory thing. It's very difficult for us to get approval to record and archive anything that discuss the ETFs. And so that's the reason. And so you have been warned. I wish it were otherwise. I really do. But that's the regulatory world as we must currently live in it. And then, by the way, like if you, you know, Brent Moores teaches some great classes. And if you go to one of Brent's classes and you're saying like, hey, what else is he teaching? Well, he's teaching managing an options portfolio on Wednesday, condors, calendars, and butterflies on Fridays. And if you are a fan of Kevin, you can come and look things up by coach. And, you know, Kevin is teaching something each day of the week. Trader Talks, 4 days out of 5, and then this building a stock portfolio on Tuesdays. Okay. Yeah, it does seem odd. I understand that, but that's the way it is. Okay. So if we want to go and look at another example, you know, oil prices, like when you think of airlines, and I think of airlines frequently because, you know, I probably did close to 20 round trip flights last year. So, you know, that's a fair bit of flying. And, you know, one of their biggest expenses, other than maintenance and equipment and all of that, has got to be gas, the fuel to fly these things. And oil prices, you know, have really been dropping. And so we're seeing a lot of airlines respond pretty favorably to that. And this is a 2-year chart. And we can see that, you know, this industry has had its ups and downs. But if we come and we look at, you know, the last 9 months, American Airlines and some of the other airlines as well, like if we look at Love, you know, it's up 23% year to date. Delta up 14. But if we look at American today, the interesting thing about this chart, you know, is that we have this bull flag, you know, where it's really been like, other than the odd 1-day pullback, it's really been uptrending. It's up 35% in the last 35 days or the last 24 trading days. And it's kind of a classic bull flag pattern, right? And then today we have this, it's maybe not a close above the high of yesterday at 1540, but pretty close. And certainly, you know, it's a bullish engulfing pattern in that this body of this candle is engulfing the candle of the previous day. And so technically that's considered an entry. And then if I'm just going to back this up a little bit. If we come and we look at, you know, well, what are they saying in the news here? Well, BMO has initiated American Airlines at a market perform with a 1675 target. That's higher than the recent high. Citigroup announces a price target of 19. You know, does this mean for sure it's going to hit that? Wells Fargo, 17. There was another one here. The price target was 20. But all of them are above this recent high. So if we said, you know, I think the airlines could continue to do well. A lot of people today, my kids included, rather than stuff, they want experiences. And often those experiences require travel and getting on planes. And so if we said, okay, you know, I'm going to look at this recent low of 1502. And I'm going to say, hey, if it goes 3% below that, I would like to exit. Now, you know, you might say, well, should we be using the 30-day moving average? Well, that hasn't really been acting as support. What we have here is a bit of a cup and handle pattern where it broke out. And so, you know, this 30-day hasn't yet been tested and held as a support level. So we might err on the side of being conservative and just put our stop, you know, below here, times 0.97. So at 1456, and if this continues to go up, we might just leave this on as a trend trade. Now, if you wanted to put a target, could we just measure the length of this pattern and repeat it? So duplicate this drawing and say, I'd like to do this, you know, with a target and based on the length of the flagpole. And so I'm going to come to my price axis and give it some more space to the upside so I can see the top of that, my flag. And I'm going to make this 1950 my target if you wanted to do this as a short-term trade. Okay. And if you just want to do this as a trend trade and then start applying, you know, the rules in your example trading plan, you can do that too. So if we're going to do that and we say, okay, we could have up to a $50,000 position, I'm going to take my 50,000 and I'm going to divide that by 15. So 3,000 shares. Well, maybe we just want to buy 1,000 shares. Or buy custom with stop and our, oh, I didn't write down that stop. 1502 times 0.97, 1456. So 1,000 shares at 1456. Oh. Let's say we're risking just under $1 a share. And so we know if we buy even 2,000 shares and have a $30,000 position, we're risking, you know, if our stop held, you know, and there's no guarantee if it gapped down, we could be out more, but we'd be risking about $2,000. So, okay, let's make this, if we made this 2,000, which seems like an extraordinary position, doesn't it? But it's an inexpensive stock in a theoretical large account. We're going to make that good till cancel, confirm and send. So that's a $30,000 position. And so that's, you know, certainly within our bandwidth, we could have done another 1,000. So we'll leave it at that. We'll put it in our growth stock group and send it in. So that's what I had for you today, guys. Thank you for all your well wishes. I want to thank Brent Moores for hanging with me in the chat and answering all your questions. He's really great at that. Scott Thompson is certainly still with us. He's just been busy, as Brent said, doing other things. He is still teaching the class on Wednesday afternoons, an introduction to stock investing. If you haven't checked that out, I encourage you to do that. I thank you for being with me today. Hit like, subscribe to the channel, and don't forget to follow Brent and I in the land of X, Brent Moore CS and Barb Armstrong CS. With that, that's the end of our live broadcast day. be back tomorrow morning with Brent Moores for Trader Talks. Have a good night, everyone. Bye for now.